Before we dive in, hit subscribe so you don't miss new episodes. If you find value, click the like button so we reach more people. Let's get started. Okay, let's unpack this. Today, we're doing a deep dive into something absolutely fundamental for anyone serious about scaling wealth in real estate, especially now: real estate finance basics. We're looking at it specifically through the lens of strategic investors thinking about 2025. We've got a really valuable guide here, a source that breaks down the key metrics, different loan types, and our mission today is really to cut through the noise, distill the absolute most important actionable nuggets from it. Think of this less as a primer for beginners and more about honing your competitive edge, unlocking that potential that goes beyond just, buying property towards sophisticated capital deployment. Yeah, and I think understanding why this granular focus is so crucial right now is key. I mean, the market today, it isn't just complex, it's dynamic, and yes, still carrying pockets of volatility. So just having access to capital, that's not really enough for strategic players anymore. You need to truly understand the architecture of real estate capital, how equity and debt integrate, how financing structures actually influence outcomes, and critically, how risk is measured and managed at a fundamental level. This really isn't about, browsing Zillow for the lowest mortgage rate. It's about mastering the mechanics of strategic deal structuring and leveraging the right financial tools for very specific situations, both to enhance returns and, crucially, protect capital.
Exactly. So for this deep dive, we're pulling out those essentials from our source material, the insights that truly matter to help you, the listener, solidify your understanding and approach opportunities with that sharper, more strategic mindset the market really demands in 2025. All right, so at its core, according to this guide, Real Estate Finance Basics, it's really the practice, or maybe the art, of structuring capital around property assets.
Yeah.
And we're talking everything from, say, a single income-producing building or a raw development site, all the way up to managing a complex portfolio. It's that critical intersection point where sophisticated investment capital meets lending capital, and where core concepts like cash flow, strategic leverage, property valuation, they aren't just theory, they're the levers you actually pull, the dials you read.
And the guide is really clear on the tangible, practical benefits this mastery provides, especially for strategic investors. With a solid grasp, you're inherently better equipped to rigorously evaluate the true viability, the potential of new acquisitions before you commit significant capital.
Right.
You gain the insights needed to structure deals that let you scale your existing portfolio much more efficiently, because you understand how to deploy leverage intelligently. And, crucially, you get the foresight to select the absolute most appropriate funding structure, the specific type of debt or capital stack tailored precisely to a project's unique asset class, its timeline, its inherent risk profile. And maybe most vital in today's environment, you learn how to use finance strategically to navigate potential market cycles defensively, protecting your downside.
Yeah, what's powerful about this, and what the guide really underscores, is that this foundational knowledge isn't just like general business acumen. It's the specific language, the toolkit, the operating system for serious real estate strategy. We're talking about investments where even a small percentage point shift in financing costs, or maybe a misdetail in loan covenants, can mean the difference between significant profit and, frankly, substantial loss. The kind of stakes involved in 7, 8, or 9-figure deals. It really elevates your role from simply being a buyer to being a capital architect.
Okay, so let's dive into the financing options. Because, as the guide points out, while a standard mortgage is what most people think of, the strategic investor has a much broader and often more specialized toolkit. The optimal approach isn't one size fits all. It's highly dependent on the specific asset type you're dealing with, the project's timeline, your liquidity needs, and your specific risk appetite.
That's where understanding the nuances is absolutely key. For instance, the guide positions traditional bank loans and commercial mortgages not just as financing, but as the backbone for properties that are already stabilized and consistently generating income.
Right, so we're talking about established office buildings, industrial warehouses with long-term leases, or maybe mature multifamily complexes with predictable cash flow history. These are the deals banks tend to like because they fit into predictable underwriting models. They typically come with fixed or variable rates, they're amortized over time, and have terms often ranging, 3 to 10 years?
Yeah, typically.
And the bank's requirements are pretty stringent. Solid borrower credit, verified property income, a conservative valuation, and often, particularly on larger loans, personal or corporate guarantees are still very much part of the package.
The upside here, and why they remain that backbone, is often you get competitive interest rates compared to alternative sources, and a degree of long-term stability once the loan is secured. But the guide does note the downsides. The approval processes can be notoriously slow, and banks are typically more conservative with their loan-to-value ratios, meaning you'll need to contribute more equity upfront.
Right, which can be a hurdle.
Yeah.
Okay, so moving beyond that standard model, our source highlights private lending and asset-based loans. This is where capital comes from non-traditional sources, think specialized funds, family offices, maybe even high net worth individuals. They step in for assets or situations that just don't fit neatly into a traditional bank's lending box.
Exactly. So why would a strategic investor turn here? The use cases, as outlined, are quite specific. Maybe you need to close an acquisition incredibly fast, or you're dealing with a distressed asset that needs significant work before it could qualify for traditional financing. Perhaps you're financing real estate for offshore borrowers where banks have hurdles, or maybe it's a niche property type like a specialized medical facility or something unique that lacks standard comps.
The pros are compelling when you need them. Speed is often dramatically faster than a bank. The loans are primarily asset-backed, which can sometimes reduce the scrutiny on the borrower's financials compared to traditional loans. And there are generally fewer bureaucratic hoops.
True, but the guide cautions on the cons, which are significant. The cost of capital is almost always higher, sometimes substantially. And these loans are often designed as short-term solutions, to get you from point A to point B, not long-term financing.
Which brings us neatly to bridge loans. Their very purpose, like the name suggests, is to bridge a short-term funding gap. The classic scenario, highlighted in the guide, is needing capital to acquire a new, potentially time-sensitive property before you finalize the sale or secured long-term financing on another asset you hold.
So they are explicitly designed as interim solutions. Maybe you need to close on a hot deal while you're still waiting for a buyer on a different property, or you need funds to renovate a property before you can put permanent financing on it. Terms are typically short, maybe 6 to 24 months, and during that bridge period, they're usually interest-only payments.
The major upside. They maintain your transactional momentum. You don't miss out on a valuable opportunity because you're stuck waiting for slower processes. They also provide flexibility, letting you avoid maybe being forced into an unfavorable quick sale of another asset just to free up capital.
But the downsides are significant. You have to remember that. They carry higher interest rates than conventional financing, almost always. And you often face exit fees or penalties when you pay off the loan, which is crucial to factor into your exit strategy modeling.
Then there's mezzanine finance. This is where things get a bit more intricate, right?
Definitely. It's described in the guide as a hybrid form of debt and equity. And it sits in the capital structure behind the senior debt, that's the main mortgage, but ahead of the pure equity from the owners.
Yeah.
It's most often used in larger development projects or maybe significant acquisitions where the total capital needed is substantial.
And what's particularly interesting about mezzanine and why a strategic investor might consider it is its primary use case, filling those equity gaps in a deal. Doing it without requiring the existing ownership group to put in more cash or significantly dilute their ownership percentage by bringing in new equity partners.
Right. The structure can be complex, though. It might include what's called an equity kicker, essentially a small percentage of ownership or warrants, or maybe a profit-sharing arrangement tied to the project's success or sale.
So the big pro is the ability to layer on significant leverage beyond what senior debt alone provides, and doing so without completely surrendering control.
Yeah, but the guide stresses mezzanine finance is typically expensive. The structures are complex, need sophisticated legal work, and they often come with stringent covenants, conditions you must meet that the mezzanine lender monitors very closely.
Okay, and finally, in this spectrum of debt, we have hard money loans.
These are explicitly short-term and heavily, almost solely, asset-backed. The lender's main focus is the value of the property itself and its potential, much more than a deep dive into the borrower's credit history or financials.
Their use cases are very specific, as the guide outlines. Projects where speed is critical and the property needs significant renovation or improvements to reach its full value. Think fix and flips, properties bought at auction, or those with significant valuation upside that needs unlocking quickly.
And the terms are tight, typically just 6 to 18 months. And like bridge loans, they're often interest-only.
Pros: incredibly fast to close compared to traditional loans, significant flexibility on borrower qualifications. And there's often no requirement to have a pre-sale or specific takeout financing lined up before getting the loan, although you absolutely need a solid exit plan.
Absolutely. Cons: they carry the highest interest rates, often very high, and usually substantial upfront fees. Plus, those tight timelines mean your execution risk is significantly higher. You have to perform.
Okay, our source also touches briefly on alternative ways to get real estate exposure for those maybe not seeking direct hands-on property ownership, looking specifically at pooled real estate vehicles.
Yeah, these structures offer different profiles of liquidity, diversification, management compared to direct ownership, which can be very attractive depending on your goals, capital size, and expertise level.
REITs, real estate investment trusts, are a prime example. These are basically companies that own, operate, or finance income-producing real estate. And you invest by buying shares in the company, much like buying stock. They can be publicly traded or private.
The upside of the publicly traded ones, as the guide notes, includes high liquidity. You can usually buy and sell shares easily on an exchange. You get passive income through dividends, which REITs are generally required by law to pay out, and you benefit from professional management of the underlying property portfolio.
The downside, well, their value can often be correlated with the broader stock market, which might negate some diversification benefits. And you have virtually no direct control over which properties are bought or sold or how they're managed day to day.
Right. Then there's real estate crowdfunding, another model highlighted. These are online platforms that pool capital from lots of smaller investors to fund specific real estate projects. Could be anything from a single-family renovation up to a large commercial development.
The major upside here, according to the source, is access. Access to a potentially wide variety of deals, types, or locations you might not otherwise have the capital or network for, and often with relatively low entry thresholds, financially speaking.
True, but the guide strongly cautions on the downsides. The quality of deals on these platforms can vary wildly, and doing your own thorough due diligence, both on the platform itself and the specific project, is absolutely critical. Don't skip that step.
Yeah, good point. And the guide's overall point about these pooled options is that they offer a scalable way to get real estate exposure, to benefit from the asset class when direct ownership isn't feasible, maybe due to capital constraints, geography, or just because it's not your desired strategy given the operational demands.
Okay, shifting gears slightly. Because a robust real estate finance strategy relies just as heavily on rigorous financial due diligence and understanding the key performance metrics of a property. Our source identifies several core numbers that you absolutely must understand inside and out when you're evaluating a deal or a loan. These aren't just numbers, they're crucial indicators of health and risk.
First up, loan-to-value ratio, LTV. For strategic investors, we know this isn't just a simple calculation, right? Loan amount divided by property value.
Exactly. And the guide stresses why understanding its strategic implication is so crucial, especially looking ahead in 2025. LTV instantly tells you the degree of leverage, and critically, it indicates how much equity buffer you or the lender have in the deal. The key investor takeaway, particularly in a market with potential value shifts, is that lower LTVs generally mean a safer position. Less equity needed up front, often better loan terms. Conversely, the guide points out that while higher LTVs let you maximize capital deployment, they significantly reduce your equity cushion, which can severely limit your liquidity or even put you underwater if values decline.
Okay. Then there's the debt service coverage ratio, DSCR. How's that calculated again?
That's taking the property's net operating income, or NOI, and dividing it by its total annual debt payments.
Right. And this is arguably the primary metric lenders focus on for income-producing property.
Absolutely. The guide highlights that it directly signals the sustainability of the property's cash flow, its ability to comfortably cover its debt obligations. A healthy benchmark one lenders typically require is 1.25 or higher.
Which means in practice, the property's income needs to be at least 25% more than the cost of servicing the debt.
Exactly. A lower DSCR signals potential cash flow distress. It's a red flag for lenders.
Okay, next is net operating income itself, NOI. Pretty straightforward. Total income minus operating expenses before debt service or capital expenditures.
And why it matters is fundamental. NOI is the core number used to determine a property's intrinsic value. It dictates the maximum loan size a lender will offer based on those DSCR requirements. And it's the basis for calculating your potential cash-on-cash return, or ROI.
A critical investor tip from the source here. Pay close attention to what's included or excluded from those operating expenses. Watch out for understated costs like optimistic vacancy projections, inadequate reserves for repairs, or deferred maintenance that will silently eat into that crucial NOI number down the line.
Very important point. Which brings us to the cap rate, the capitalization rate, calculated by taking the property's NOI and dividing it by its purchase price or current market value.
The cap rate serves as a quick way to gauge the initial unlevered yield or return on investment. and it provides a basis for comparing relative value and perceived risk across different assets or markets.
And the guide specifically notes a relevant trend for 2025. Cap rates have widened slightly across certain asset classes. They attribute this significantly to broader global uncertainty and the volatility we've seen in interest rates.
So this widening means properties might be generating similar NOI but trading at slightly higher yields, lower prices relative to income.
Potentially, yes. Compared to recent past periods, it might offer different entry points but also reflects perceived risk.
Okay. And finally, interest rates and the specific loan terms are obviously critical, beyond just the rate itself.
Right. You have to strategically consider fixed versus variable depending on your hold period and rate outlook. You need to look closely at prepayment penalties. Do they restrict your exit flexibility? And understand the amortization schedule. How quickly are you actually paying down principal?
And the strategic insight from the guide here, particularly relevant in potentially higher or volatile rate environments like the one mentioned influencing cap rates.
Yeah, the insight is that short-term fixed rates or even strategically managed floating rate structures might offer more flexibility or even cost savings depending on your market outlook, your hold period, and your overall risk management strategy compared to maybe locking into a long-term high fixed rate right now.
Okay, let's shift gears because a truly robust real estate finance strategy isn't just about optimizing returns. It's fundamentally, maybe even primarily, about proactively managing downside risk. Our source identifies several key risks.
First and foremost, and highly relevant now, is interest rate risk. We've seen rates can be volatile, and this can quickly and significantly impact your debt service costs, particularly on floating rate loans, really squeezing your cash flow.
So the primary solution proposed by the source is strategic. Either lock in fixed rates when the market offers favorable terms. Or, if you choose floating rate loans for flexibility, consider using interest rate caps or swaps as a hedge to limit how high your payments can climb if rates spike.
Exactly. Then there's liquidity risk. Real estate, unlike stocks or bonds, is inherently illiquid. Trying to sell quickly in a downturn can be incredibly costly, requiring a deep discount maybe, or even functionally impossible if financing just dries up.
So the suggested solutions from the guide are pretty pragmatic. Maintain adequate buffer capital. Cash reserves are easily accessible lines of credit. Things you can tap into to weather potential downturns or cover unexpected costs without being forced to sell at a bad time.
Right. The guide also suggests, if it fits your strategy, maintaining some exposure via more liquid avenues like publicly traded REITs as part of a broader portfolio.
Regulatory and tax risk are also significant factors, the guide mentions. Policy shifts, federal, state, local. They can affect everything from zoning rules impacting development.
Yeah, to tax treatment of rental income or capital gains, even how loans themselves are structured or regulated. The source acknowledges this as a constant risk requiring vigilance. It doesn't offer a single silver bullet, implying it's something you must continuously monitor, adapt to, and factor into your financial models.
Makes sense. Finally, geographic concentration risk. Having too much capital tied up in a single market magnifies your exposure to that area's specific issues. Economic downturns, political shifts, industry problems, even environmental risks.
And the straightforward solution recommended is diversification. Spread your investments geographically across different regions and also across different asset classes within real estate, not just office, but maybe industrial, multifamily, retail, niche categories, to hedge against those localized downturns.
Our source also gives a brief but important nod to regional considerations. This is vital because, as they note, different markets really do have different playbooks for finance.
Absolutely. The types of financing available, local tax laws, how lenders underwrite deals, perceive risk. It can vary substantially depending on where the property is. Local expertise is critical if you're operating across different regions.
They point out a few specific examples. In the UK and Europe, lending is described as remaining relatively conservative compared to other markets, and development finance specifically tends to be highly localized, needing deep understanding of regional planning and funding.
Whereas in the Asia-Pacific region, the guide notes continued strong growth in mixed use and urban renewal, often with complex financing, plus increasing access to offshore capital.
And in the Middle East and the U.S., the source mentions a trend towards more structured equity models in larger deals, and notes that recent credit tightening in traditional banking actually opened up significant opportunities for private lenders and debt funds to step in.
So drawing this all together, what does this really mean for you, the strategic investor, looking at 2025?
Well, to summarize the source's core message, Whether you're looking to deploy significant capital into stable assets, start a complex development, or just gain scaled exposure, a solid, sophisticated command of real estate finance basics, understanding the tools and the metrics, is absolutely non-negotiable.
Yeah, we've seen how key metrics like DSCR, NOI, LTV, they aren't just arbitrary numbers. They provide that essential data-driven lens into an asset's true performance, its cash flow sustainability, its risk profile, both from a lender's view and your own.
And we've explored how understanding that whole spectrum of financing types, from bridge loans for timing to mezzanine for capital gaps, hard money for value add plays, it offers tailored strategies to fit precise timing, risk tolerance, and return objectives that go way beyond just a standard mortgage.
Right. And the source's final point is a powerful reminder. The most successful investors in real estate, they're rarely just passive buyers. They're actively, strategically structuring their capital stacks. They're proactively managing risk based on clear, quantifiable metrics. And they're leveraging finance not just as a means to acquire, but as a dynamic, adaptable tool for growth and capital preservation in what is, let's face it, a constantly shifting market.
So let's leave you with this thought, building on the source's emphasis on strategic adaptation and market navigation. Given the ongoing volatility and uncertainty mentioned, and the variety of sophisticated financial tools and metrics available beyond the basics, how might you fundamentally rethink your approach to real estate this year? Not just thinking about it as acquiring property, but as actively structuring capital and managing risk in this truly dynamic and often unpredictable market environment. Thanks for listening. If this helped or made you think, hit like it shows this content matters. And tap subscribe if you haven't yet. See you next time.